Well, the Happiest Minds stock has made a lot of investors very happy because the stock is up 290% in the last few months, but it has slipped post its Q1 numbers. And the company has posted strong revenue growth. The problem was in terms of margins that contracted a little bit due to the wage hikes. To discuss their Q1 fine print, CNBC TV18's Narayanan caught up with the management. Let's hear out what they had to say.
As far as demand is concerned, the heartening factor is that across all our verticals, we've seen a strong uptick in demand, whether it's edutech, retail, high-tech, media and entertainment, and industrial and manufacturing. And the other part of how we look at our business is the different geos. And again, we've seen all of the geos having good growth in pipeline, as well as, if you look at our results, all of them have shown growth on an absolute basis. And this is something that we expect will continue for the rest of the year, just given that there was quite a bit of pent-up demand, as well as, the overall economic conditions are improving and customers have realized the need to do more of digitization and adopting of digital technologies. Venkat, do you want to talk about our margins?
Yes. So, Rima, before I get into margins, I just want to highlight two numbers. One is the revenue growth, which has been a solid 10% QOQ and almost 41+% on a YOY basis. So that sets to rest the whole aspect of the growth that we've been talking about. In the earlier calls, we have said that we would target or look to grow at about 20% on an organic basis on a consistent basis over the medium to long term. So pretty much these numbers are higher than those, but we hope to keep the trend going forward. Again, if you look at the EBITDA number, we are at about 26.1% this quarter compared to 26.3% last quarter. So the margins really have not declined. In percentage terms, we've held on to the 26+%, and in absolute terms, we've moved from about 59 crores to about 66 crores. So effectively, if you're looking at margins from operations and other income, it's improved on a quarter-over-quarter basis, on an annualized basis. And if you look at it on a year-over-year basis, we have moved from 48 crores to 66 crores. So I would like to just correct that viewpoint that margins have actually been impacted. Yes. If you look at the operating metrics of gross margin, there has been a drop of about 170 basis points. This was expected given the wage hike that we had taken this quarter. And also there is a net addition of about 310 people. So the cost of those employees or Happiest Minds has also hit our P&L. When you look at PBT and PAT, that's where you're seeing a drop. And effectively that's on account of the exceptional item and also the tax impact that we've had this quarter.
So, Venkat, what would be the FY22 margin guidance? You had earlier spoken about 22 to 24%. Does that hold?
We still are holding to the 22 to 24%. Yes, last year we had quite a few unknowns in terms of how long the work from home benefits, travel restriction benefits, I'm talking of them as benefits from a cost standpoint, would sustain. We are seeing that continue through Q1 now and likely to see this through Q2 and Q3. But we are also making sure that as and when vaccination pace picks up and our people are vaccinated and there's a larger crowd of people around are also vaccinated, getting them back to office slowly. So some of these benefits that we have in margin improvement will slowly retract and head towards the 22 to 24%, which we have been guiding.
Joseph, particularly about BFSI, the revenue contribution has fallen from 17.4% to 13.4% over the last 2 quarters. So it's lower than the company average, the growth. What is happening?
So if you look at it at an absolute level, there's been a marginal growth in BFSI. But as a percentage, it has dropped because it's not kept pace with the rest of the revenues. As compared to Q4, there are 2 factors at play. The first is one of our larger customers in the BFSI segment. We were doing a turnkey project for them, and we are in the process of completing the big chunk of the work which got done in Q4. That's had a little bit of an impact. The second factor is that we've been going to market with some of the fintech SaaS companies, taking them to market and implementing them for mid-market banks. So we've had some good traction, but when you have a large program, that sort of tapers off, this strategy will not allow you to to make up for the revenue. In the future quarters, we expect this program to again get into the next phase, and so we will see an improvement. We're also
okay, time for a quick break now, but